Hello students and welcome to the lecture. So students, as we know that we are covering the banking awareness practice question. This is going to be our part 6. Like previously we have discussed about the part 5. Now it is the part 6. Basically in this lecture, we will cover some practice questions. Okay. And at last we will do the summary of all of them. This is what we are going to do. But before this, there is a small disclaimer that is presented over here. The disclaimer that we are required to understand before we proceed. The images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, please contact us at sathee@iitk.ac.in and we shall remove the images. Now let's begin with the question number 1. When the Reserve Bank says that the rupee is overvalued, it means RBI has shortage of hard currency. It has to order for printing of new notes to the press concerned. Rupee is appreciating against the other currencies, whereas other currencies are weakening against US dollars. Money is locked in banks and people do not have enough to make their day-to-day purchases. It is a strategy which brings the inflation down. More and more people selling their stocks. As a result, stock market may crash as there is no hard crash for such voluminous transactions. None of the above. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is B. Go by the explanation. Rupee appreciating against other currencies means that the Indian rupee is gaining value relative to the other currencies. For example, if one INR could buy 0.013 USD before it, and now it can buy 0.014 USD. That means the rupee is getting more dollars in exchange. So that's why it is called as the 1 rupee has been appreciated. This can happen due to several factors like strong economic indicators, positive economic data from India such as higher GDP growth, low inflation or a trade surplus could boost investors' confidence in the rupee. Foreign investment, increased foreign direct investment or foreign portfolio investment into India could lead to higher demand for the rupee, causing it to appreciate. Monetary policy, if the RBI raises interest rate, it could attract foreign investors looking for higher returns, increasing demand for the rupee. Political stability, a stable political environment could enhance investor confidence, leading to an appreciation of the rupee. Now let's move forward. Question number 2. RBI's open market operation transactions are carried out with a view to regulate liquidity in the economy, prices of essential commodities, inflation, borrowing power of the banks, all of the above. Again, you will have 10 seconds to answer, then I will give you the answer. Time starts now. Time's up. Correct answer is E, all of the above. Go by the explanation. Liquidity in the economy. The primary function of open market operation is indeed to regulate liquidity. By buying or selling government securities, the RBI adjusts the amount of money circulating in the economy, influencing how much cash banks have available to lend. Prices of essential commodities. While OMOs do not directly target commodity prices, they could indirectly influence them. Changes in liquidity could affect demand in the economy, which in turn could impact prices of essential goods. If liquidity increases, consumer spending might rise, potentially leading to the higher prices. Inflation. OMOs plays a crucial role in managing inflation. By controlling the money supply through liquidity management, the RBI could influence inflation rates. If liquidity is too high, it could lead to the inflation, while too low, liquidity could contribute to deflation. Borrowing power of the banks. OMOs could also affect the borrowing power of the banks. Increased liquidity allows banks to lend more, while reduced liquidity could restrict their ability to lend, influencing their borrowing capacity from the Reserve Bank of India. Question number 3. What do we mean by the bank rates? Rate of interest charged by commercial banks from borrowers. Rate of interest at which commercial bank discounted bills of their borrowers. Rate of interest allowed by commercial banks on their deposit. Rate at which RBI purchases or rediscounts bills of exchange of commercial banks. None of the above. Again, 10 seconds you will have. Time starts now. Time's up. Correct answer is D. Go by the explanation. Bank rate definition. The bank rate is the rate at which the Reserve Bank of India lends money to the commercial bank, typically against eligible securities. It is also the rate at which the RBI discounts bills of exchange that commercial banks present. This rate is a crucial tool for controlling liquidity and influencing interest rates in the economy. Question number 4. What is an Indian depository receipt? Option: deposit account with a public sector bank, deposit account with any depositories in India, an instrument in the form of deposit receipt created by an Indian depository against underlying equity shares of the issuing company, instrument in the form of deposit receipt issued by Indian depositories, none of the above. 10 seconds you have to answer. Time starts now. Time's up. Correct answer is C. Just go by the explanation. Definition of Indian Depository Receipt (IDR). IDR is a financial instrument that allows investors in India to invest in foreign companies' equity shares without having to trade in foreign stocks directly. The Indian depository issues these receipts against the underlying shares held in a custodial account. How it works: when a foreign company wants to raise funds in India, it could issue equity shares, which are then held by the domestic depositories like National Security Deposit Limited or Central Depository Services Limited. The depositories then issues IDRs to Indian investors, which represents these underlying shares. Now, the question number 5. An instrument that derives its value from a specified underlying currency, gold, stock, etc., known as derivative, securitization receipt, hedge fund, factoring, venture capital funding. To answer this, you will have 10 seconds. Time starts now. Time's up. Derivative. Go by the explanation. Derivative is a financial instrument whose value is derived from the value of an underlying asset, which could be a currency, commodity like gold, stock, or other financial instruments. Common type of derivatives including the options, futures, and swaps. Now let's move to the question number 6. Reverse repo means injecting liquidity by the central bank of a country through purchases of government securities, absorption of liquidity from the market by sale of government securities, balancing liquidity with a view to enhance economic growth rate, improving the position to availability of the securities in the market, none of the above. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is B. Let's go by the explanation. Reverse repo definition. Reverse repo or reverse repurchase agreement is a monetary policy tool used by the central bank, like the Reserve Bank of India, to absorb excess liquidity from the banking system. In a reverse repo transaction, central bank sells government securities to commercial bank or financial institutions with an agreement to repurchase those securities at a later date. How it works: when central bank sells these securities, it takes cash out of the banking system, thus reducing the amount of money available for lending and spending in the economy. This process is used to manage liquidity effectively and could help control inflation. Question number 7. Currency swap is an instrument to manage currency risk, interest rate risk, currency and interest rate risk, cash flows in different currencies, all of the above. To answer this, you will have 10 seconds. Time starts now. Okay, the time's up. Correct answer is all of the above. Go by the explanation. Currency risk. Currency swap allow parties to exchange cash flows in different currencies, helping to hedge against the risk of fluctuating exchange rates. Interest rate risk. They facilitate the exchange of interest rate, fixed or floating, which could help manage exposure to changing interest rates. Cash flows in different currencies. Primary function of a currency swap is to enable the efficient transfer of cash flows in different currencies, which is crucial for international transactions. Now, question number 10. Eurobond is an instrument issued in the European market, issued in euro currency, issued in the country other than the currency of the currency of the bond. All of the above, none of the above. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is C. Just go by the explanation. Definition of Eurobond. Eurobond typically defined as a bond that is issued in a country other than the country whose currency the bond is denominated. For example, a bond issued in the US but denominated in euros is considered a Eurobond. Other option, issued in the European market. While many Eurobonds are issued in the European market, okay, the Eurobond itself does not imply that it must be issued in Europe. It can be issued globally. Issued in euro currency. Like we could say, Eurobonds could be dominated in any currency, not just euros. Therefore, this statement is misleading. Third is all of the above. Since option A and B are not entirely accurate description of Eurobonds, this option is also incorrect. And when option C is correct, so automatically option E, none of the above, would be incorrect. Question number 9. Money laundering normally involves placement of funds, layering of funds, integration of funds, all A of A and B, C. None of these. To answer this, 10 seconds, time starts now. Time's up. Correct answer is D. All of A, B, and C. Go by the explanation. Money laundering typically involves three main stages. First is placement. This is the initial stage where illegal funds introduced into the financial system. This could involve depositing cash into banks or using it to purchase assets. Layering. In this stage, the aim is to obscure the origins of funds, done by moving to the money through a complex series of transactions, such as transferring funds between different accounts, using shell companies, converting cash into other forms of value. Integration. The final stage involves reintroducing the laundered funds into the economy in such a way that they appear to be legitimate. This could involve investing in legal businesses or purchasing the real estate. Question number 10. The IMF and the World Bank were conceived as institutions to strengthen international economic cooperation and to help create a more stable and prosperous global economy, promote international monetary cooperation, promote long-term economic development and poverty education reduction. All of A, B, and C, none of these. Answer this, you will have 10 seconds. Time starts now. Time's up. A, B, and C are the correct answer. Just go by the explanation. Strengthen international economic cooperation. Both the IMF and the World Bank established to promote collaboration among countries to foster a stable and prosperous global economy, involving addressing financial crisis and ensuring a cooperative international financial system. Promoting international monetary cooperation. IMF specifically focuses on international monetary cooperation by providing monetary stability, facilitating balanced growth of international trade, provides policy advice, financial strength, and technical expertise to other members, promote long-term economic development and poverty reduction. World Bank's primary mission is to reduce poverty and promote sustainable economic development, provides financial and technical strength for development projects that are expected to improve the economic prospects and quality of life for people in developing countries. Question number 11. What is the call money? Money borrowed or lent for a day or overnight. Money borrowed for more than 1 day up to 3 days. Money borrowed for more than 1 day up to 7 days. Money borrowed for more than 1 day but up to 14 days. None of the above. 10 seconds you have to think and answer. Time starts now. Time's up. Correct answer is money borrowed and lent for a day or overnight. Go by the explanation. Call money refers to the short-term borrowing and lending of funds, typically for a very brief period, often overnight or for just one day. Commonly used in the internet bank market, where banks lend to each other to manage liquidity and meet reserve requirements. The loans could be called back by the lender at any time, which is why it is referred to as call money. This instrument crucial for financial institutions to maintain adequate cash flow and manage short-term liquidity needs. Question number 12. Which of the following is the regulator of the credit rating agencies in India? RBI, SBI, SIDBI or SEBI? Or none of the above? So, 10 seconds you have to think and answer. Time starts now. Time's up. Correct answer is SEBI. Go by the explanation. SEBI stands out for Securities and Exchange Board of India. It is a regulatory authority for the securities market in India, and it is responsible for overseeing and regulating credit rating agencies as well. SEBI's roles include ensuring that credit rating agencies operate in a fair and transparent manner, sets guidelines and standards for their functioning, primarily regulates banks and non-banking financial institutions, while SBI and SIDBI have specific roles in banking and development finance but do not regulate credit rating agencies. Question number 13. What is future trading? It is nothing but the trade between any two stock exchanges wherein it is decided to purchase the stocks of each other on a fixed price throughout the year. Arrangement between two parties to buy or sell underlying assets in the future at a predetermined price. Agreement between stock exchanges that they will not trade the stocks of each other under any circumstances future for a given period of time. Out of this, which is correct? To answer this, you will have 10 seconds. Time starts now. The time's up. Correct answer is B, only second. Go by the explanation. This description is inaccurate. Future trading does not involve a trade between two stock exchanges to purchase stock from each other at a fixed price throughout the year, instead involving agreements on the future price of an asset. 2. Correct definition of future trading refers to an agreement between two parties to buy or sell an underlying asset at a predetermined price on a specific future date. Is a fundamental nature of futures contracts. Statement 3. This statement is incorrect. Future trading does not involve agreements between stock exchanges not to trade stocks. Rather, it pertains to individual agreements between buyers and sellers regarding the future sale of assets. Let's move forward. Question number 40. Green banking means financing of irrigation projects, 1 lakh projects, 1 banks, development of forestry by banks, financing of environment-friendly projects by banks, managing fishing by banks, none of these. Answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is C, financing of environment-friendly projects by banks. Go by the explanation. Green banking refers to the practices and initiatives adopted by the banks and financial institutions, supporting sustainable development and promoting environmentally friendly projects, including financing renewable energy projects, energy efficiency improvements, sustainable agriculture, and other initiatives that contribute to environmental protection and sustainability. While option A, B, D touch on specific sectors, they do not encompass the broader concept of green banking, which is focused on environmentally sustainable finance. Question number 15. Free international trade leads to the equalization of prices in both the countries, international price with domestic price, commodities of both the countries, trade between two countries, none of the above. To answer this, you will have 10 seconds. Time starts now. Okay, the time's up. Correct answer is A. Go by the explanation. Price equalization. Free international trade promotes competition and allows goods to be exchanged without tariffs or restrictions, often results in price equalization for similar goods across different countries. When product is cheaper in one country, demand for that product increases there, leading to higher prices. Conversely, the exporting country might see decrease in supply, causing prices there to fall. Over time, these dynamics help align prices between the two countries. Second, international price with domestic price. While free trade does influence the relationship between international and domestic prices, The emphasis on equalization is more likely captured by option A. Commodities of both countries. This option is about the types of goods exchanged and does not pertain to price equalization. Trade between two countries. Option describes the act of trading itself rather than the equalization of prices. None of the above. This operation is incorrect as option A accurately reflects the key outcome of free international trade. Question number 16. Which one of the following is not a quantitative control method of credit control? Cash reserve ratio, statutory liquidity ratio, bank rate, selective credit control, none of these. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is D, selective credit control. Go by the explanation. Quantitative control methods. These methods aimed at regulating the overall supply of money and credit in the economy, like cash reserve ratio, percentage of a bank's total deposit that must be kept in reserve with the bank central bank, SLR, minimum percentage of a bank's NDTL that must be maintained liquid assets, bank rate at which the central bank lends money to the commercial bank, influencing the cost of borrowing and credit availability. Selective credit control, method considered a qualitative control rather than a quantitative one, involving directing credit to the certain sectors or industries rather than controlling the overall supply of money, aims at controlling the flow of credit to specific sectors to ensuring the balanced economic growth. None of these. This option is incorrect because option D is indeed not a quantitative method. RBI helped to finance India's foreign trade through it SBI, Exim Bank, NABARD, none of these. To answer this, you will have 10 seconds. Time starts now. Okay, the time's up. Correct answer is C, Exim Bank. Go by the explanation. Exim Bank stands out for Export-Import Bank of India. Primary role of Exim is to finance and facilitate international trade, specifically for exports. Provides financial strength, support and advisory services to Indian exporters, thus directly aiding India's foreign trade. 8B. Industrial Development Bank of India. While it supports industrial financing, it does not specifically focus on foreign trade. SBI. Although SBI does not provide services related to the foreign trade, it is a commercial bank and not primarily a foreign trade financing institution. NABARD. National Bank for Agriculture and Rural Development. Focuses on financing and supporting rural development and agriculture, not specifically through foreign trade. None of these. This option is incorrect because Exim Bank specifically addresses the financing of foreign trade. Question number 18. When the prices of a substitute of a commodity X falls, then the demand for X rises, falls, remains unchanged, first rises and then falls, none of these. Answer this, you have 10 seconds. Time starts now. Time's up. Correct answer is B, false. Go by the explanation. Substitute goods. These goods could replace each other in consumption. For example, if commodity X is butter and a substitute could be a margarine. Effect of pricing. When the price of a substitute for commodity X falls, consumers are likely to buy more of the cheaper substitute instead of commodity X. As a result, the demand for commodity X decreases. Conclusion. When the price of a substitute of a commodity falls, demand for X falls, making the option B correct choice. Question number 19. Provision of credit and other financial services and products of very small amount to the poor in rural, semi-urban and urban areas enable them to raise their income living and living standards known as microcredit, personal banking, corporate banking, non-banking finance, none of these. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is A. Go by the explanation. Microcredit refers to the provision of small loans and financial services to low-income individuals or group who lack access to the traditional banking services. The aim of microcredit is to empower the poor, enabling them to invest in income-generating activities, improving their livelihoods, enhancing their living standards. Personal banking involved banking services offered to the individuals, typically not focused specifically on small amounts for the poor. Corporate banking focused on providing financial services to corporations and large businesses, not individuals in need of small loans. Non-banking finance refers to the financial services provided by NBFI, but it is a broader category, does not specifically denote the provision of small loans to the poor. Question number 20. The National Stock Exchange functions from New Delhi, Kolkata, Mumbai, Chennai, none of these. Answering this, you will have 10 seconds. Time starts now. Time's up. Correct answer is C, Mumbai. NSE of India is headquartered in Mumbai, one of the leading stock exchanges in India, and was established to provide a modern, fully automatic electronic trading system. Other options like New Delhi, Kolkata, and Chennai do not host the NSE. Question number 21. Fiscal policy did 2. Issue of currency, credit creation, public revenue expenditure, all of these, none of these. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is C, public revenue expenditure. Go by the explanation. Fiscal policy refers to the use of government spending and taxation to influence the economy. Involves decision about public revenues and public expenditure. Issue of currency, primarily the function of central bank, not directly due to the fiscal policy. Credit creation, typically associated with the monetary policy, involving the management of money supply interest rate by the central bank. All of these, since only public revenue expenditure directly due to the fiscal policy, this option is incorrect. None of this. This option is also incorrect because fiscal policy does involve public revenue and expenditure. Question number 22. Inflation implies rise in budget deficit, rise in general price index, rise in price of consumer goods, rise in money supply, none of this. Answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is B, rise in general price index. Go by the explanation. Inflation defined as sustained increase in the general price level of goods and services in an economy. Over a period of time, it is commonly measured by the changes in general price index such as consumer price index or wholesale price index. Rise in budget deficit. While a budget deficit may be influenced by inflation, it does not directly represent what inflation implies. Rise in price of consumer good. A specific instance of inflation refers to the overall increase in the general price level, not just consumer goods. Rise in money supply. Potential cause of inflation, but it does not define inflation itself. None of these. Option is incorrect because inflation is indeed related to the rise in the general price index. Question number 23. Which of the following organization known as the market regulator in India? SEBI, IBA, MFI, NSDL, none of these. To answer this, 10 seconds you will have. Time starts now. The time's up. Correct answer is SEBI. Go by the explanation. SEBI is the primary regulator for the securities market in India, responsible for protecting the interests of investors, promoting the development of securities market, regulating its functioning. IBA, representative body of banks in India, does not serve as a market regulator. AMFI, organization involved in the mutual fund sector but does not act as a market regulator. And SDL, organization involved in the electronic holding of securities and settlement of trade. It is not a market regulator. Question number 25. The terms entry load and exit load most frequently used in the context with the following: health insurance, real estate, mutual funds, housing loans, none of this. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is C, mutual funds. Go by the explanation. Entry load and exit loads typically common issued with the mutual funds. Entry load, fee charged when investor purchases unit of a mutual fund, percentage of amount invested and dedicated from the investment before the units are allotted. It's worth noting that many mutual funds have eliminated entry loads in recent years. Exit load, fee charged when investor redeems sell unit of a mutual fund, apply to discourage short-term trading and typically calculated as a percentage of the amount redeemed. Question number 25. Federation of Indian Chambers of Commerce Industries, FICCI, was founded in 1927 by Birla and Tata, Tata and Thakurdas, Thakurdas and Birla, Tata and Godrej, none of this. To answer this, you will have 10 seconds. Time starts now. Correct answer is B. Tata and Thakurdas. Go by the explanation. Established 1927 primarily by J.D. Tata and G.T. Thakurdas, who were significant figures in the Indian business community at that time. Aim was to create a platform for the Indian business community to promote their interests and facilitate trade. Birla family played a crucial role in Indian history. Not worthy founders of FICCI, therefore option C is not correct. With this, we have finished this topic. Now it's a part for summary. We have talked about overvalued rupees, RBI supermarket operation, bank rate definition, Indian depository receipt, instrument driving value. Reverse repo definition, currency swap management, euro bond definition, money laundering studies, IMF and World Bank purpose. Then call money definition, credit rating agency regulator, future trading definition, green banking definition, pre-international trade leads to. Quantitative control method of credit control, RBI and foreign trade financing, effective substitute price change, microcredit definition, national stock exchange location. Fiscal policy focus, inflation implications, market regulator India, anti-load and exit load context, FICCI founders. So with this note, we have finished this lecture. It is requested to all of you kindly revise the facts and figures at all we have discussed in this lecture. Keep yourself ready for the next lecture. With this note, let's end this lecture and thank you.